As of today, Friday, January 9, 2026, Vistra Corp is trading at 172.53 USD, which is up a staggering $21.93 or about 14.56% since the opening bell. If you have been watching the ticker on your Robinhood app or checking your individual brokerage account this morning, you probably saw a massive vertical line that looks more like a high-growth tech firm than a traditional utility company. This price action is not just noise, it is a fundamental shift in how the market values power generation in the age of massive data centers. While most people see Vistra as a company that simply keeps the lights on, the reality is that it has just positioned itself as a primary landlord for the infrastructure that runs modern artificial intelligence. The immediate driver for this double-digit jump is the announcement of a massive 20-year power purchase agreement with Meta Platforms. We're talking about more than 2,600 megawatts of carbon-free energy coming from 3 of Vistra's nuclear plants. If you use Interactive Brokers trading or keep an eye on Fidelity Wealth Management reports, you know that securing clean, 24/7 baseload power is the biggest bottleneck for the tech giants right now. Meta is effectively pre-ordering the entire output of these plants for the next 2 decades to support their new AI initiatives. This is significant because it is not just about selling electricity, it's about the nuclear uprates. Vistra is actually going to increase the output of these plants through equipment upgrades, which is essentially creating new capacity out of thin air to meet Meta's demand. The common expectation for a stock like VST is that it should behave like a defensive play, something you hold for a stable dividend when the broader market gets shaky. But the reality we are seeing today is that Vistra is behaving more like Nvidia stock in terms of momentum. Investors who were once looking for investment help with safe, boring utilities are now finding themselves in the middle of a high-stakes land grab for energy. This Meta deal is the largest of its kind in United States history, surpassing the high-profile deal between Constellation Energy and Microsoft that happened last year. By locking in a 20-year contract, Vistra has essentially removed the commodity risk from a huge portion of its portfolio. They are no longer just subject to the whims of daily electricity price fluctuations. They have guaranteed high-margin revenue coming in for the next 20 years. If you are currently managing your own SoFi Invest or using the Fidelity trading platform, you might be wondering if you missed the boat. To understand the momentum, we have to look at the trading volume. Today's volume is already several times higher than the daily average, indicating that institutional funds are rotating out of traditional growth sectors and into these AI-adjacent infrastructure plays. While Apple stock and Tesla stock often dominate the headlines for retail investors on the Robinhood mobile app, the big players are realizing that those tech companies cannot grow without the massive power generation that Vistra provides. This creates a fascinating tension. The market narrative says we are in a tech cycle, but the reality is that we are in a power cycle. Let's talk about the business model because it is often misunderstood. Vistra is an integrated retail electricity and power generator. They own the plants and they also own retail brands like TXU Energy. This means they can play both sides of the market. When wholesale prices are low, their retail business thrives because they can buy cheap and sell to residential customers. When wholesale prices are high, their generation fleet makes a fortune. Recently, they've been aggressively expanding. Just earlier this week, they closed a $4 billion acquisition of Cogentrix Energy, which added about 5,500 megawatts of natural gas generation to their portfolio. For those of you who use SoFi Active Investing to look for value, this move was a clear signal. Natural gas is the bridge that keeps the grid stable when the sun isn't shining or the wind isn't blowing, and Vistra now has one of the largest gas fleets in the country to complement its carbon-free nuclear assets. Comment below how many shares of Vistra Corp you currently hold, or if you think the nuclear energy trend is just a temporary hype cycle for the utility sector. Looking at the technicals, the stock has been on a tear for the last year, but today's breakout takes it into new territory. If you check your Interactive Brokers platform, you'll see that VST has significantly outperformed the S&P 500 and most of its peers in the utility sector over the last 5 years. The expectation was that high interest rates would hurt companies with heavy infrastructure costs, but the reality is that the demand for power is so inelastic that Vistra can pass costs through while still maintaining massive margins. This is why you see it being added to many Schwab Intelligent portfolios and other robo-advisor models that look for high-quality, cash flow positive businesses. The risk profile here is something every person who is self-investing needs to consider. While the Meta deal is a massive win, it also ties a significant portion of Vistra's future growth to the continued growth of data centers. If there's a slowdown in AI spending, or if the hyperscalers like Google and Meta find ways to make their chips twice as efficient, the projected demand for all this new power might soften. However, the current reality on the ground is that the grid is stressed more than it has been in decades. In regions like the PJM market where Vistra operates, the shortage of reliable power has sent capacity prices to record highs. This is why Vistra is such a popular choice for those looking to invest online in the energy sector. They aren't just selling a product, they're selling a solution to a national energy crisis. When you look at the financials from their most recent reports, there was a slight miss on earnings in late 2025 due to some maintenance outages and market-to-market derivatives losses. For a less resilient company, that might have been a disaster, but the market looked right past it. Why? Because the forward guidance for 2026 and 2027 was raised. They are projecting an adjusted EBITDA of nearly $7.6 billion by 2026. If you're using investment sites to compare valuations, you'll notice that Vistra trades at a higher multiple than a regulated utility like NextEra Energy, but that's because Vistra is a merchant generator. They can capture the full upside of rising electricity prices, whereas a regulated utility is limited in what they can charge. This merchant model is exactly what makes VST a favorite for active traders on the Robinhood trading platform. We also have to consider the legislative environment. The federal government has been pushing hard for clean energy, and nuclear fits that bill perfectly. By extending the licenses of their plants for another 20 years as part of the Meta deal, Vistra is securing its status as a green energy leader without the intermittency problems of solar or wind. For people holding Fidelity mutual funds or Fidelity ETFs focused on ESG or clean energy, Vistra is increasingly becoming a core holding. It represents a pragmatic approach to the green transition, using existing nuclear assets to fuel the most advanced technology on the planet. If you're scanning for the next big move in your individual brokerage, keep an eye on the institutional activity. We have seen massive positions being built by firms like BlackRock and JP Morgan in the last few quarters. They are not buying for a 5% dividend, they're buying for the structural re-rating of the entire power sector. The days of utilities being widows and orphan stocks are over. In the current landscape, Vistra is a growth engine. Even the volatility we see on days like today, where the stock swings nearly 15%, is more characteristic of a high-flying tech stock. This creates a unique opportunity for those who are online investing to catch a wave that is driven by physical reality, the need for actual physical electrons to power the digital world. The contrast between expectation and reality is most visible in the company's capital allocation strategy. Most utilities spend all their cash on dividends and interest payments, but Vistra is aggressively buying up its own stock. They have already repurchased about 30% of their outstanding shares over the last few years and recently authorized another $1 billion for buybacks. This shows a management team that believes the market is still undervaluing the long-term cash flow potential of their assets. When you see a company with this kind of pricing power and a shrinking share count, it creates a coiled spring effect for the stock price. For those of you using SoFi trading platform or managing your own Fidelity IRAs, the question is how much exposure you want to this specific niche. The energy sector is historically cyclical, but we're entering a phase where the cycle is being overwritten by a permanent step function increase in demand. Every single AI query uses 10 times more power than a standard Google search. Every new data center being built in Northern Virginia or Ohio needs a dedicated power source. Vistra isn't just selling a product, they're selling a solution to a national energy crisis. In summary, the 14.56% gain we are seeing today is a reaction to the market finally pricing in the meta effect. The expectation was that Vistra would eventually find a partner for its nuclear fleet, but the reality of the scale and duration of this deal, 26 years and 2,600 megawatts, exceeded even the most bullish analyst projections. Vistra now is the gold standard for how power companies can partner with big tech. They have successfully transitioned from a legacy power company into a high-tech infrastructure play. While the price at $172.53 USD might seem high compared to where it was a year ago, the underlying value of its contracts and its newly acquired natural gas fleet suggests that the story is